Um, I was going to start with something that we have discussed or was on the roadmap pre-exploit, and maybe now is the time to talk a little bit more about it, which is the Beanstalk DEX. Can you maybe briefly tell us again what was the idea behind the Beanstalk DEX and how would that work and where does it fit in the future of Beanstalk?
Sure. So the basic idea is that current implementations of decentralized exchanges, in order to attract liquidity, all impose some sort of trading fee. And at heart, the economic incentive to provide liquidity, or maybe not at heart, this is economics, at its core, the incentive for providing liquidity is that trading fee. And that's the case on Curve, that's the case on Uniswap, that's the model for every single decentralized exchange. And in short, in order for a decentralized exchange to have utility, it needs liquidity. So it imposes this fee to attract liquidity to create utility. Now, Beanstalk has demonstrated a pretty clear ability to attract liquidity without trading fees, right? I think it's a reasonable assumption that the main reason people were providing liquidity in the silo prior to the attack was not for the trading fees in the silo. It was for the Bean seigniorage. And so the thesis behind the Beanstalk DEX, or the expansion of the market, might be the way to say it within the current Beanstalk lingo, would be to implement or facilitate the deployment of a variety of different AMMs or other decentralized exchanges, or facilitate other decentralized exchanges, I should say, in a permissionless fashion without any trading fees. And the main reason for that is because people can provide liquidity at the base layer, whether that's providing Bean ETH liquidity. There shouldn't be a trading fee in that pool, or there doesn't necessarily have to be a trading fee in that pool, or whether that's trading deposits on the root marketplace. None of that should have any fees. And so the concept is to fully generalize the Beanstalk market to facilitate trading fungible and non-fungible assets without any trading fees. And that can be facilitated because of Beanstalk's ability to attract liquidity without trading fees, because of the seigniorage.
Okay, and where do we think this is as a priority? When will we want to work on this, and what pool would we expect, to launch first on this DEX, or what non-Bean assets would be there to be tradable?
The first thought would be the Bean ETH pool. Over time, you'd like the Beanstalk market to facilitate a variety of different AMMs or price invariants. To start, it's likely going to be a constant product Bean ETH pool. Over time, you could implement various different price invariants as well. That's just on the fungible token side.
Okay, Harry Smith asks, when can we expect a Bean ETH pool? I guess my question would be as well, would we have a Bean ETH pool on Uniswap, or the plan is to launch it on the Beanstalk DEX?
I think the hope would be the first Beanstalk DEX AMM would be the Bean ETH pool, and that would be a constant product pool. I think that's the goal to work towards, and I don't think it's unreasonable to make it a goal to have that deployed by the end of Q3.
Okay, how will this work, or the DEX work? Will the DEX share all of the liquidity that's in the silo? So anything that's in the silo is tradable?
Well, there's a lot of different ways to build markets on and around the silo. If we take root as an example, the concept is for people to be able to take their deposits and enter their deposits into trades that settle based on various different things. So that's perhaps a more sophisticated version of trading deposits. That's not immediately trading deposits. I guess you could trade deposits for one another. You could trade FERT for deposits. You could trade pods for deposits. As soon as the withdrawal freeze is down to zero. I guess you don't even need the withdrawal freeze down to zero now that deposits are transferable, although you probably want it to be in order to facilitate all this stuff, but it's not a requirement. Lots of different stuff you can build on this.
Okay. I'm going to discuss or ask further questions on this. Let's say now I have Bean ETH tokens deposited in the silo, and that will be used for the Beanstalk DEX. And then a user wants to come and buy whatever, all of the ETH that we have. So they would come in and buy as much ETH as they can. This basically means that Beanstalk doesn't have as much ETH as it did before, but it will still owe the same tokens to the depositor. The same way if I had been ETH deposited before and someone just came and bought all of the ETH in it. Am I understanding this correctly?
No. So providing liquidity by holding Bean ETH LP tokens would be the same as holding Bean ETH Uniswap LP tokens, save for there's no fee earned for providing liquidity. So you're still exposed to impermanent loss. The only way to buy ETH from that Bean ETH pool is to sell beans into the pool, right? So if there's a sale of beans into that Bean ETH pool, the amount of beans that you would own relative to the ETH that you would own would increase.
Not sure if I followed. So I'll ask it again, and maybe you can explain it again. So where is the ETH coming from? If someone wants to come and buy ETH, isn't that ETH taken from the silo deposits?
Well, it's not taken from the silo deposits. It's taken from the liquidity pool.
Yes.
Right? So you're going to have another liquidity pool that is beans and Ethereum. And then what's deposited in the silo are the Bean ETH LP tokens. But it's not the change in the underlying ratio of beans to ETH doesn't affect the deposits other than if you were to redeem the deposit, the amount of beans and the amount of ETH that you would receive would have changed.
Okay. Let's say a scenario now that, we had two pools. With 50% it was Bean ETH, and then the other 50% was Bean 3 curve. And then, once again, someone came and, bought, 25% of, the ETH that we have for 3 curve. And now the deposits or the ratio that we're having in the silo is, 25% Bean ETH and 75% Bean 3 curve. So far, so good. Is that correct?
Well, that's not really the way it would work, right? So if there's two pools that are half beans and half ETH and half beans and half 3 curve, and you assume that there's equal liquidity in both, if somebody wanted to get the most value for selling a significant amount of beans, they would sell them across both pools in some amount. So let's assume that they're sold in both pools to significantly lower the bean price, right? So beans are sold, ETH and 3 curve are removed from each pool. The ratios of the pools are changed. Now what?
So I am the person who wants to use the Beanstalk DEX. I have 3 curve with me. I want to swap it with ETH. So I would come in. In the back, what happens is that I'm buying Bean, and then I'm buying Bean from the 3 curve pool, and then I'm selling it in the Bean ETH pool, and then I'm taking ETH out. Correct?
Yeah. So if you were going from 3 curve to ETH in the Bean pool, that is correct. You'd be selling the 3 curve into beans and then taking the beans and buying ETH with it. That's correct.
So then the 3 curve Bean pool will be, will have more 3 curve, and the Bean ETH pool will have, less ETH. So you'd expect arbitrageurs to take the Bean or the excess Bean that's in the Bean ETH pool and send it to the Bean 3 curve to balance the pools. Correct?
Well, you can assume that keep in mind that the price invariance that the pools use may not be exactly the same. So the ratios of Bean to ETH and Bean to 3 curve may not be the same, but the price that you'll get per BDV should trend, assuming that there's an efficient market. The arbitrageurs should arbitrage the prices of the pools to a common BDV, a marginal BDV.
Yes. So let's now compare the state before the change and after the change. So before the change, it was 50-50, three curve ETH. And now after, the swap, it's more concentrated towards three curve in our example. Is that correct?
In the case where someone sells a significant amount of beans for three curve, or which we've given a couple examples.
Yes, where someone swapped, three curve for ETH through the Beanstalk DEX.
Yes. In that case, there would be a slight increase in the amount of three curve and a decrease in the amount of ETH. That's correct.
Okay. Would Beanstalk ever want to put ratios where it says, once I reach below, let's say 20% of ETH, then I don't want to, swap the ETH anymore because this is the diversification, or this is the ratio that we want? Do you think we'll ever want to do that, or we don't care? Can't take all of our ETH?
So interestingly, Mad, I think that, if you assume an arbitrager is acting efficiently, the thing that will determine the ratio of ETH that is being provided as liquidity in the silo relative to three curve, that's not a function of the market itself, because you can assume that those prices will all be efficient. The question is, what will people choose to hold their exposure in if they're providing liquidity in the silo? So I have deposited LP tokens. Would I rather have deposited ETH or deposited three curve? And I think we're a ways away from this being implemented in practice. But in a perfect world, you can imagine Beanstalk having, instead of fixed stock and seeds per BDV, or maybe fixed seeds per BDV, depending on how you want to implement it, you can instead have target ratios of different assets that Beans trade against. So you can have the amount of seeds per BDV deposited, or the amount of stock and seeds per BDV deposited, probably just seeds, but maybe both, change over time autonomously based on the ratio of being three curve relative to being ETH in the silo, to make holding ETH exposure in the silo more attractive or less attractive than holding three curve exposure or holding LUSD exposure. Does that make sense? But it's not related to the market itself. You can assume that the market would be pretty efficient. So the real question is, what do people want to hold exposure to?
Yes, that's clear, and thank you for taking the time to answer these questions. All right. Once again, if anyone has questions or follow-ups on what we discussed or anything else, feel free to drop them in the town hall chat. Otherwise, I'll start with another question, Publius, and this may not be very Beanstalk related, but we'll continue with that. I wanted to discuss a little bit about inflationary and deflationary currencies. So we have right now Bitcoin and Ether. They're both deflationary in their maybe not Bitcoin in specific, but Ether in specific is deflationary. Generally speaking, when you have a currency that's so let's talk a little bit about inflation. High inflation, we know why it's bad, and maybe it's commonly known why high inflation is bad. And generally, it's because people will start, the value of the money that I'm holding is losing its value, so let me spend it now instead of holding it later. And this is also the reason for why, low inflation or really low inflation is also bad, because then people will hold onto their assets and, they will not spend it in the economy or not use it as a currency. So my question is, if Ether being deflationary, if we reach to a point where, Ether now is stable, it's not, as volatile as it is, let's say now, do you still see it being used as a currency, or just given its deflationary nature, it cannot really be used as a currency because people will always want to hold Ether and not use it?
All right, so that's a very interesting question that you asked, but also an interesting premise. And I do want to comment on the premise before we get to answering your question. So I think high inflation I agree, is obviously bad because it's very hard to predict things and make proper spending decisions in the future if the value of the asset that you're saving is depreciating in 20% a year, 50% a year, it's very hard to accrue purchasing power over time, right? Like save, as you said, there's no incentive to save whatsoever. And I think if we think about incentive to save, what is an incentive to save? It's looking towards the future, right? And when there's high inflation, it's very hard to have a high time preference. Now, when there's low inflation, but not inflation, when there's low inflation, that allows people to both make decisions that are based on somewhat stable economic data, but as well as that, you have a complementary, the stability that comes with low inflation allows people to think towards the future more than in a high inflation environment. Now, where I think it's very obvious that a low inflation environment is better than a high inflation environment, but there is a very interesting question around whether a deflationary environment is better than a low inflation environment. And this is sort of fundamental economic question, perhaps one of the ultimate questions, where we will find out if the market would prefer either a disinflationary and then at some point deflationary asset like Bitcoin, or whether the market prefers a true disinflationary asset like Ethereum, a true deflationary asset like Ethereum. Although I think under the current structure of the way the ETH supply changes based on demand for block space, it's actually sort of reflexive. So the idea that the price is going to stabilize over time, not sure how likely that is based on the current minting schedule. But if we take your premise that the ETH price has stabilized significantly relative to general purchasing power, even if that's priced in US dollars, whether you can think about it as purchasing power against a basket of goods, whether people would prefer to own a deflationary asset or a low inflation asset, hard to say ultimately. And this is one of the questions that we kind of highlighted in the article that we published before the Replant started, or the barn race started, excuse me, which is if over time the market prefers a harder asset than Beans, despite the benefits of the distribution from the seigniorage and the competitive carrying costs associated with it, perhaps it is a sub-optimal currency compared to Bitcoin or Ethereum once those prices have truly stabilized. But that's something that is going to take decades, if not longer, to happen. And in the meantime, there's very clearly a need for lower volatility assets than Bitcoin and Ethereum with competitive carrying costs. So I actually am going to kind of not answer this one and don't know what the answer to the ultimate question is. I think we'll find out collectively as a civilization over time. But this is an economics question that the market's probably going to have to answer in due time. I can't answer it.
Okay, and I agreed with you on the bits of a deflationary asset, holding it makes sense. And do you think deflationary currency makes sense as kind of currency? Isn't this opposite to what it's meant to be? A currency is supposed to be used so people will transact with it. If it increases in its value by doing nothing, why would I ever want to use it?
Well, I don't agree with the statement that the currency is supposed to do certain things. In practice, the market has selected different currencies that have very specific properties. But I think that it's hard to, if we take a little bit of a step back here, the introduction of Bitcoin, which what it really fundamentally did was allow for salability of value across space and time in a much deeper way than gold in a previous sense, and then Ethereum generalized permissionless compute. This is a whole new, one of the kind of guiding principles behind working on Beanstalk is that this technology, this whole landscape is ripe for the creation of new money that doesn't really fit into or pushes against previous economic paradigms at a core level. And so answering questions about, is it better to have a deflationary or an inflationary currency, sort of miss the point, right? The point is that the market is going to decide what is better. And very clearly right now, the market requires a low volatility asset. And the only way to create low volatility is, I guess, without collateral, is through inflation. So then the question is, what do you do with the inflation? And if you look at a design like Terra, right, the inflation from the demand for the stable asset, all of that went to speculators in the value of Luna, not to the stablecoin holders. And that created perverse incentives that ultimately led to the system becoming way over levered with not enough liquidity, not enough desire to hold the stablecoin itself, and at some point it imploded. But the question is really fundamental. You can get the incentives right. And in Beanstalk, there's very clearly an incentive to hold exposure to the stablecoin itself. And that the rewards for holding exposure to the stablecoin are anti-reflexive, meaning the marginal benefit for holding exposure to the stablecoin or purchasing additional exposure to the stablecoin increases as the price increases and decreases as the price increases, or at least as much as possible on the latter end, because you do have the inorganic demand problem. But that's really the fundamental question Beanstalk is trying to solve, whether in the grand scheme of things, over the scale of centuries, the market will prefer a truly hard asset like Bitcoin or a low volatility positive carry asset like Beanstalk or Beans. Very hard to say. But I think that the thing that we're working on right now is to create the best version of Beanstalk such that it can stand the test of time and live for hundreds of years and ultimately allow the market to decide, just like over millennia, the market has chosen gold and chose silver to a large extent as well as the most marketable and most saleable goods to be used as store of value and medium of exchange, that hopefully if Beans demonstrates sufficient robustness and low volatility in the bean price and competitive carrying costs, that it perhaps stands a chance at deserving a place in the history books in the grand scheme of things from a monetary perspective. But whether the market will choose a deflationary or an inflationary asset or an asset that doesn't change in supply like Bitcoin, hard to say. Hard to say what will happen.
Okay, going to build up a little bit on this. Now, the bean right now follows the inflation of the US dollar. So let's say, it or tries to follow it at least. So
well, as a minimum, right? So
yes,
the bean supply actually increases with the inflation of the US dollar and the increase in demand for beans. But
yes, I meant as how would bean be used in an economy in general, if people wanna spend it or not, it would more or less follow the US dollar because it follows the same inflation that it takes. So let's say if we had an ETH that Beanstalk issues another bean that is pegged to Ethereum, then that would be deflationary as a single unit in its nature, outside of what happens from seigniorage. What I'm thinking right now is, and following up on the idea of a little bit of inflation is good because it encourages people to spend what they're having, and that stimulates the economy to an extent. Is how can Beanstalk do this to its own to whatever is on the bean economy? And for now, let's take root as an example, and maybe in the future it will be other participants or other things on it. What if we introduced a little bit of inflation to the seigniorage in the silo? And this is how it would work. So let's say someone has some deposits in the silo, and then you get 100 beans as seigniorage. Beanstalk will give you 90 beans, and then it will give you 10 other beans that will get burned through time if you don't spend it. And you can only spend these in things that are within the Beanstalk economy. So let's say you get your 100 beans. you can do all whatever you want.
I would just immediately interject and say Beanstalk probably doesn't want to impose some sort of fee on people like this. And additionally, I don't necessarily subscribe to the notion that you need low levels of inflation to encourage people to spend. I think there's some evidence to that extent, but I think it's a more complicated problem than that. And in particular, when you're talking about building the bean economy, the reality is that people are going to the benefits of holding exposure to beans in the silo are enormous, particularly in the first couple of years of the system. There's a lot of seigniorage. And the result is that it's very hard to take money out of the silo and do real stuff outside of the silo and compete with the yield from the silo. The opportunity cost is too high. And so the reality is that in order for there to be a bean economy, what you need is for people to be transacting in deposited beans, right? So everyone is constantly earning the seigniorage in real time and transacting in beans. And that is where, and you alluded to it, Root is particularly exciting. That's because that is an implementation of markets for deposited assets. So the starting point is people have these deposits. They want to start to do things with them, whether that's spend them. They want to spend them at the very last minute, and they want to spend them, they want to spend their beans. They don't want to have to sell them into ETH and then into USDC and use dollars, or they want to just use their deposits at the very last second. You need people to start to accept the deposits on both ends. That's what, when you talk about a bean economy, I think that's where things get more interesting, as opposed to imposing some sort of artificial cost on people for not spending their beans. That would be my first reaction.
I agree. I mean, I have also reasons to why in the long term this doesn't work. I was more thinking of the idea of stimulating, if we choose, to simulate our own, let's say, protocols, then would that work?
It might work, but I think it's a little cheating.
It is. And, it's encouraging people to do something versus then holding it. And in the long run, anyways, the stimulus eventually gets translated into an increase in price. So you stop having, that short-term productivity, and it just gets translated into higher prices, and you stop there. Okay, thank you for having this discussion.
Maybe just, if we go back to the comment earlier about new tech being built on Ethereum, you've never really had the opportunity to hold dollars in a bank account and earn interest on them that is the result of seigniorage from the printing of new US dollars, So in the past, you can either hold the deposits in the bank account or you can spend them. This is really the closest thing to a new digital version of that, where you're earning the most competitive, risk-free from the, assuming you're taking on Beanstalk risk, the risk-free rate of return, the Beanstalk native minimum rate of return. You're earning that for being in the silo. That's like the starting point for a new economy. You need that before you can anything else.
I agree. Okay. That's it from my side. I also don't see questions on the town hall chat, so we'll give it a minute or two if anyone has another question. I see Max was typing one, so maybe we'll take that. JDAPS is following up on the Bean ETH pool. Yes, we discussed that, and the plan is to hopefully launch a Bean ETH pool on the Beanstalk DEX. And correct me if I'm wrong, Publius, we're looking at end of Q3 or maybe early Q4.
Yeah, definitely. That's a short-term priority. Not sure exactly when that'll be, but I think end of Q3 or early Q4 is very reasonable.
Maxo asks, the USD analog to transacting inside of Beans would be like paying someone in US treasuries, more or less. You take that.
I think it would be closer to trading bank deposit, right? Where you're earning the interest on your deposit account until the very last second. But it's also not unlike trading treasuries.
Smith asks, where can I find more info on the DEX plans? So we've earlier discussed it on the 6-month road plan, which was pre-exploit. There's nothing new discussed in there, but there will probably be more info coming out soon.
Yeah, I think it's one of those things that will, as opposed to like one big thing, it'll just be a bunch of small things that over time comprise the market. So, the market is pretty limited at the moment. Right now, you can just trade pods, but over time, it should support a bunch of different stuff, all without fees.
All right, I think we reached the end of the questions. We might end class here. Publius, if that's okay with you?
Perfectly okay with me. Perfectly okay with me. This is it's all very exciting stuff. So we've got the DAO meeting on Thursday. The vote ends on Friday. Replant, God willing, on Saturday. This is all very exciting. So if anyone has any questions about Replant or anything like that, in the meantime, between now and then, definitely shoot us a message in general or the questions channel. Happy to answer any and all questions, and very excited to get this thing back up and running. Very, very excited.
Same here. And just to remind everyone, there is no action needed from Replant to unpause except picking your beans if you want to take them and deposit them into the silo. Is that correct?
Yes. And then after Replant, as fertilizer is sold and people receive revitalized stock and seeds, they may want to figure out a cadence to enroute their revitalized assets. That's the one manual behavior that's additionally introduced in addition to the mow and plant.
Yeah, that's akin or similar to farming stock pre-exploit.
Yeah, you can think of it like that to some extent.
Okay, I see Jams typing. He asked if we hit 50% quorum. I don't think we've hit it yet, but you'll know once we do.
I think I'm checking the Discord bot. It says 49%.
Yeah, almost there.
Very cool. Very cool. Very exciting, guys.
Definitely is. All right. Thank you, everyone, for joining class. Thank you, Publius, once again for taking time. And we'll see you in the DAO meeting and then in next week's class.
Take care.